Hey, what's up guys? John here. Elon Musk company Tesla just received a lower ESG score than a tobacco company. You might wonder, well, how is that possible? And how are these scores even determined? Well, there's a much bigger question to ask besides that, is what is this future actually going to look like? Right? What does this actually mean? Well, I did research for about 5 hours for you to break down exactly how this is going to impact everybody and everything, from auto insurance, property insurance, residential home loans, commercial insurance, even air travel. All of these things are about to go through such a massive change. So if you're investing in, maybe you're investing in companies, maybe you want to buy a business or start a new business, pay attention to what's going on with ESG. Because whether you like it or not, or you think that's not going to happen or not, it is going to happen. I mean, when I show you these numbers of how many companies are actually behind on this, how many people are actually invested, how much capital is actually deployed, and what is going on that's already law, you'll see clearly what the future is going to look like. And, as I've always said, smart person sees things for how they really are, and everyone else sees things for how they want them to be. So look at the facts, and then, of course, I'll always leave all the facts in the show notes below this video. You can do your research as well. But hit the like button. You want to hit the like button, YouTube will share this content. If not, whatever. Also, today's video is sponsored by GreatCreditFast.com. GreatCreditFast.com. We'd love to help fix your credit. If you have situations on your credit report that are holding you back, we'd love to give you a free consultation to see how we could be of assistance. What we're seeing right now is the greatest wealth transfer of all time. And if you have bad credit and you're living day by day and hoping that this situation is going to, just go away with making the minimum payments, it's just going to get harder as they continue to increase interest rates, inflation gets worse, and the economy gets worse. But take a look at this. Elon Musk says ESG is the devil, with tobacco firms trouncing Tesla in social responsibility rating. Elon Musk slammed the framework that evaluates companies' environmental, social, and governance standards, flagging that tobacco firms tend to receive higher ESG ratings than electric vehicle makers. Why ESG is the devil, the Tesla and SpaceX chief said on Twitter in response to an article the Washington Free Beacon reported. ESG is a set of standards meant to assess business practices in relation to sustainability and ethical concerns. An increasing number of financial market participants use ESG-based ratings as a guidance for socially responsible investing rather than simply buying assets they think will deliver the best returns. Now, choosing Elon Musk to give this rating to was very smart on their end, because it's going to get basically everyone aware about this, talking about this, having an opinion on this, and then it allows for more of a adoption to start to take place, and that's exactly what's going to be happening next. So I was looking at this like, how are these scores really calculated? How do they determine these scores? Well, these are some of the rating agencies, the Carbon Disclosure Project. So I started looking at these. Carbon Disclosure Project. Now, investors with US 136 plus trillion in assets are requesting thousands of companies to disclose to them through the CDP in 2022. So this already happened. 18,700 companies with over half of global market capitalization disclosed in 2022. Let that sink in. 18,700 plus companies worth half of the global market capitalization disclosed last year. 280 CDP supply chain members, major buyers with 6.4 trillion in procurement spend, requested thousands of their suppliers disclosed through CDP in 2022. Okay, now you might wonder, well, what does this mean for banking, right? What does this actually mean for banking? Well, we start to look at bank service partners, right? And you'll see, as clients and investors' expectations grow for financial institutions to integrate sustainability considerations such as environment, social, and governance factors into their lending. Investment products portfolios, navigating the fast-moving space can be challenging, right? We usually look at this. Insurance. The insurance industry is a pivotal point as it grapples with fulfilling its purpose in a complex, rapidly changing environment. The challenges are manifold. They include finding yield and market volatility, rising inflation, tighter margins, intense competition up front in the minds of many of the risk management and growing requirements incorporate sustainability and climate, right? But they go on to kind of break all this down, how they can take control of their portfolios and how they can measure risk better and where they should stay away from and how they should underwrite everything. So now, I'm not saying this to concern anybody, but I am saying this because I want people to see things for what they really are and how things are actually going to move forward, how they're going to be moving forward. This is all going to change. Like, look at commercial banking, for example. Commercial banks have a critical role in financing the transition to a low-carbon, sustainable, and equitable future. Our ESG specialists support you with essential sustainability and intelligence to stress test climate-related risk, maximizing green financing opportunities, and respond to investor demand for increased ESG-focused organizational activity. Now, you click here. It says understanding the impact of this on their loan portfolio. On their loan portfolio, it says climate means that we may face more frequent or severe weather events such as floods, droughts, typhoons if action isn't taken. These events being physical risks that can have a negative impact on business and the overall economy. At the same time, steps taken to help alleviate climate can result in transition risk as carbon taxes and other policies and new operating costs. This is a complex interplay between physical and transition risk that can impact the operation and sustainability, stability, creditworthiness, and financial performance of times. Now, they continue to break this down. I'll leave all this in the show notes. But when you look at this, even right now, if you Google or you search for a flight, let's say you are in New York, you want to fly out of JFK, and you want to go to Heathrow in London, right? And you want to take that trip. Right now, it says that it is optional, right? It's optional. And for that, it might be, let's call it 9 hours. So you might pay an extra $19 for that flight. Now, many people, they start low, of course. Many people, it's optional. You know, it'll start at 19 bucks, go to 30 bucks, 50 bucks, 100 bucks. Over time, the cost of that flight is going to be so expensive. They're not going to have it as $19 to where it's going to be, you know, something that is just like some small little tax. It's like buying a couple cups of coffee or something like that. No, this is actually going to get very, very, very expensive, which is ultimately going to push air flights very, very, out of reach for most, right? We're going to continue going through this until we start to see a lot of people not being able to travel. Now, when you go through this list, you can kind of see the MSCI. You can start seeing these lists, right? And so you look at how this whole thing is played out. It's interesting. So look at this. It says, who are we, right? Or who we are. Morningstar provides high quality analytical environment, social, and governance research ratings for more than 30 years, right? And so they have 1,000 clients, and they have 18 out of 20, the top 20 asset managers, right? 18 out of 20. And look at their footprint. I mean, they're going everywhere. This is going to be, I mean, even Bloomberg launches a proprietary ESG score. And this is how they say it's calculated. But since they get to calculate this based on their findings, you think about how much authority that has over everything. Because it's not as though it's some type of like clear clear format people can follow. It's these rating agencies that are going to be stepping forward and determining who is good and who is bad, basically. And I mean, look at that. And this is worldwide. This is happening. And so you look at their staff too. They got they are pushing exactly what they want. Like they even do black and white photos, right? You can see this is exactly what's going to happen. They don't want to have even color in photos. But yeah, I mean, it's going to be interesting. We're stepping into a very unique period in time. I think we're going to start to see a lot of businesses flourish, and we're going to see a lot of businesses really suffer over the coming couple of years as this begins to become much, much more mainstream. And when we start to look at what's going on in commercial real estate right now, we start to look at what's actually happening. Everything is being pushed forward as this climate situation. And many people be like, oh, this isn't happening. This isn't that big of a deal. Like, look at what's going on in New York right now. In New York, right now, they have they're pursuing all these different fines, but they say the law sets a limit of greenhouse gas in buildings starting next year, January 1. So in 5 months, right? 5 months. This isn't like 5 years from now where people are like, forget it. It's like, robots or something that maybe will happen, maybe it won't happen, that people, can write off. This is 5 months from now. In 5 months, they're saying that 5,500 buildings 5,540 buildings must comply, 832,000 apartments, and total fines $200 million, right? $200 million out of a total of, they're saying the same study found 3,700 properties could be out of compliance with $200 million per year in penalties, but by 2030, that number's going to $900 million a year, right? About $1 billion a year. Now, you have to ask yourself, how can these properties even do these upgrades in the next couple years when, we're going to likely see rents soften further, interest rates remain elevated, insurance and taxes continue to rise, and you're going to start seeing a lot more offices becoming vacant simply because people are going to be moving out of these high tax and high cost living environments and going to places that are a little bit more affordable just to keep their business afloat. So what are you going to have? You're going to have a situation where a lot of these buildings are not going to be able to afford all of these upgrades. And as that's happening, you're going to start to see mass defaults. I mean, that's what it looks like to me, but I'm curious, what does this whole thing look like to you? Where do you see all this going? Drop below, hit the like button, subscribe here, and add me on IG for content you're not going to find here. At This Is John Williams on IG. And if you want to fix your credit, you want to position yourself for the greatest wealth transfer of all time, we'd love to help you at greatcreditfast.com. That's greatcreditfast.com. Catch you guys in the next video.